we are projecting an acceleration in growth relative to last year. So growth for Sub-Saharan Africa was of the order of 2.8% last year, and we're projecting that it will accelerate to 3.4% this year, and a little bit further in the 2019 onwards. Importantly, we're going to see growth accelerating in 2/3 of the countries in the region this year. So in general, we're seeing a pickup from the difficult couple of years that the region has been going through in the wake of the commodity price declines. However, I really need to stress that this 3.4% number that we talk about for the region as a whole masks quite a lot of diversity in terms of growth outcomes. So we still have quite a few countries that are growing at 5, 6, 7% and more. So the likes of Cote d'Ivoire, Senegal, Tanzania, Ethiopia are all growing fairly robustly at 7, 8%. What is lowering this regional average number of, and holding it well below the 7, 8% some countries are growing is the fact that you still have growth in some of the larger economies in the region, the South Africa, Nigerias of this world, still being of the order of 2%. So they've emerged from recession, but growth is still well below the levels that they were growing at in the years past. So overall then, picture is one that is much better than the last couple of years, growth accelerating, reaching 3.4%, but that average number masks quite a bit of heterogeneity in the region.
And I know the growth across the region, I mean, many times it's country-specific, but for you, what will be the key drivers, the common denominators and key drivers of growth that you see? Okay,
so this year, a couple of important influences on growth. I think the first one is that the global economy continues to improve. So growth globally has been accelerating. So that's been helpful. And with that, we've also seen higher commodity prices. That will be beneficial for those countries that are commodity exporters, of course. On the other hand, countries that are oil importers, other commodity importers in the region, and there are many more of those than our commodity exporters, those will be impacted somewhat negatively. But these two factors overall have had a beneficial effect on the growth numbers I outlined. Another external factor has been that volumes of capital inflows have been quite significant to Sub-Saharan Africa in particular, at least through the first quarter or so of the year. So these global factors.
Capital inflows, what about, FDI?
The FDI volume numbers are still not out yet, but what we've seen instead are, Eurobond issuances have been very high by countries in the region, but also money into the equity markets and local bond markets have been really very significant. So those have, that confidence, at least in terms of international capital portfolio type flows, has been very significant.
But around that issue of capital inflows, we've seen, especially in a country like Nigeria, but we're seeing normalization of monetary policy in developed economies, particularly with what the US Fed is doing, and there are concerns that there might be some capital reversals as fund managers begin to weigh the risks of putting cash in frontier markets that they perceive may have some more risk. Nigeria, for example, we're going into an election cycle. That's an additional political risk for such fund managers. It might be temporary, but I'm thinking, is that something you also take into consideration?
So you come to the second part of our message. In terms of, so we've been welcoming very much the improvement in growth outcomes. But the second part of our message is that, what we've seen also is that there still remains quite a bit to be done to make sure that we go back to the 5-6% growth that the region has been enjoying in the recent past. And really, that's the level of growth you need at a minimum to be able to hit the sustainable development goals and the improvements in standards of living that we need to see. Now, in terms of this outlook that you highlight, going forward, part of the concern, of course, is that this, at least in terms of capital flows, there are types of flows you cannot rely on to help finance long-term infrastructure objectives, investment in health, education. So, they provide you some liquidity now. They provide you a higher foreign exchange, but that's not the kind of flows that you can rely on. And indeed, we do warn about the likelihood that these flows could reverse very quickly, and policies, the macroeconomic environment has to be robust to potential reversal in such flows. So that's one of our policy messages. The other two messages that we have are particular attention is needed to public sector debt levels, which have been going up in recent years, particularly in the commodity exporting countries. Part of this has had to do with the fact that growth has slowed in many countries, exports have been hit, so you're seeing debt levels going up on account of that. But in many countries also we've seen public spending increases being very, very aggressive, at least relative to revenue collections. So going forward, countries need to strike a healthier balance between the much continued need to address these development spending objectives that they have, but also making sure that those are financed through domestic revenue mobilization rather than just debt financing. So the balance needs to be recalibrated.
Okay.